What I'm going to do is I'm going to talk about some of the trends that we're seeing in the market at the moment, and then I'm going to share some of the things that we expect to see in the market for 2018 and beyond. And we'll start off at the global level, and we'll move into Europe and then finish on the UK. Now, if we starting globally, I think it's fair to say that 2016 and 2017 has been a very strong year for investment activity overall. So this is some data showing us inflows into major global regions, and we've got our own estimate there for the level of activity that we expect to have seen this year. So slightly less than what we saw in 2016. We're thinking around $800 billion invested. And the question that we get a lot at the moment is, have we reached the peak of the current investment cycle? And I think the answer that we think is, well, actually, yes, we probably have in absolute volume terms. We certainly don't think there's going to be a major slowdown coming for 2018, but we do think that maybe things have just leveled off. On the other hand, activity is going to remain robust and certainly above long-run average levels. But in a way, that's almost the sort of least interesting part of this. I think what's much more interesting is what's actually driving this activity and what's behind this. And clearly, a really important part of the global market at the moment is the nature of cross-border capital flows into different parts of the global real estate market. Now, this is clearly something which is, broadly speaking, on the rise overall. Real estate is still globalizing as an asset class, but it's not entirely a one-way street. So, a lot of the investment outflows recently have come from emerging markets, but as those markets mature, we see investors there having sort of more reason, more opportunity to invest locally as well. And again, if we look at what's happening in the US, never been a massive recipient in percentage terms of cross-border capital flows. And as we can see, things have been trending down here lately as well. That's sort of a mixture of things. It's pricing, it's dollar appreciation, it's China pulling back slightly. On the other hand, Europe particularly has been a very strong beneficiary of the recent capital flows that we've seen going cross-border. So much so, in fact, that in Q3, the share of investment into Europe coming from overseas was the highest level it's ever been, so it was over 50%. And I think that's a really good example of where investors are looking at very strong improved growth prospects, and they're trying to chase that, trying to take advantage of that. And it's easy to forget just how significantly the improvement in economic growth prospects have been in recent years. Now, clearly, when we look at what's going on in the emerging markets and developing markets, they're always going to be the most dynamic. But actually, I would say, in a way, the growth in the advanced economies that we're seeing at the moment is almost the most encouraging part. And particularly when you look at Europe, if you look at any of the recent GDP numbers, PMI readings, what you see is that, yes, Germany is perhaps taking the headlines, but actually growth has been very, very strong across all of those sort of core European markets. That's leading to stronger consumer sentiment, leading to greater expectations for capex. As you go further towards Central and Eastern Europe, these things are only improved upon. So, very, very strong outlook there. In relative terms, relative to what we're used to, not surprising to see that quite a bit of investment activity at the moment is focused quite heavily on Europe. Now, there are other drivers, anything ranging from the threat of nuclear war to the rise of global populism. These are things that clearly drive people to invest their money elsewhere. And I think these things are sort of worrying to an extent, but we have to sort of concede that actually we've lived with these things for a while now. They are things that have been sort of ongoing, and yet we've seen this relatively strong pickup in global growth. I think the consensus when we speak to our overseas investors and our overseas offices is that, generally speaking, people can rationalise things like changes in tax rates, rising interest rates, and even Brexit to an extent. What's really difficult is when you get decisions that are made on a whim and a sort of genuine sense of uncertainty as to how things are going to pan out. And particularly for individuals and families, that is when people start coming to us and looking to move capital on a sort of preemptive basis. And there's definitely a number of regions in the world at the moment where we're seeing that sort of actively happening at the moment. So this isn't going to go away in 2018. Uncertainty is going to be a driver of capital flows globally, and a lot of that is going to drive flows towards the developed markets in Europe and the UK and places like the US. more generally, I think this is part of a broader global theme. We are seeing a change in the nature of global capital flows, and this data is looking at the source of funds for cross-border capital flows back in 2007 and today, if you like. And really, the really big change here is the difference in Asian outbound capital. 10 years ago, 6% of global capital flows. Today, it's almost a third of the whole market. So very, very significant change. We're hearing a lot at the moment about China, capital controls and what that's going to mean. Now, our sense is that, yes, this is important, it's restricting activity at the moment, but real estate is on the restricted list, it's not on the banned list, along with some of the sort of more vice-like investments that people have chosen to do. So, that's one thing. The other thing is sort of on the softer side, our sense from our colleagues in that part of the world is that this was very, very important for the Congress earlier in the year, but actually, they expect this to come under less scrutiny as the year progresses, and maybe nothing will be said, but I think we'll start to see some of those restrictions easing a little bit. Now, we could talk a lot about the sort of the global pools of capital that will be trying to go into real estate in a greater way over 2018, be they the institutional funds or the sovereign wealth that are trying to increase their exposure to real estate. I think maybe we'll touch on that on the panel later as well. So what I was going to do is just pick out one particular buyer group, really from the other end of the spectrum, if you like, and that is private wealth and private capital generally. Now this is quite important to our residential business in particular, and a lot of my colleagues in our residential research team spend a lot of time trying to understand whether the world's ultra-high net worth individuals should be investing in things like this or this or this, and they tell me this is quite tough work. Apparently, this gets summarised in the annual wealth report that they create. But I think for us, what's really interesting in here is for the last couple of years, there's been a much greater recognition that commercial real estate should be on the radar of these kind of investors. And we've seen that this year as well. I mean, if you look at the global trophy asset deals that have taken place, a number of them have been bought by private individuals or privately backed vehicles. So just really to highlight some of the sort of figures from this, which illustrate that this is a growing trend. 27% of transactions this year were privately backed in some form. So this isn't necessarily literally individuals buying buildings, but it's their family offices, it's the vehicles that they fund with their own money. So that's a big number, and it's up from 20% 10 years ago. So there's growth there as well. When we look at the number of ultra high net worth individuals, we see that there's growth of about 8,000 of these kind of people every year. So these are people with more than $30 million of investment that they can make. And this is clearly growing at a rapid rate. The interesting thing is that most of these people currently are all based in the US predominantly, but really the growth is definitely coming from Asia. So that's going to rebalance, we think, over the next decade. And then perhaps most importantly, when we speak to these kind of investors, these kind of families, almost a third of them expect to invest in real estate abroad in the next couple of years. So we can't help but think that this is going to be a continued strong driver of activity as we go into 2018 and beyond. Now, over to Europe. I think Europe's really interesting at the moment because clearly in the press, everywhere you look, sentiment is so strong. And actually, when you look at what's happened to investment activity, I mean, we've got an estimate here. Again, it doesn't look as though we're necessarily going to have a stronger year than we saw in 2016. And I think part of the reason for that is that it's quite easy to forget, but earlier in the year, I mean, there was a sort of genuine sense of unease about the election cycle. I mean, we did really have some worries about populist governments getting in the event. That didn't happen, and we've forgotten about it all. But that was, I think, an issue at the start of the year. And then underlying all of that, really, we've had a market in which there's been huge amounts of demand, but there hasn't necessarily been the stock available to go and buy. I mean, there hasn't necessarily been the motivation from sellers to sell. Some funds have extended. So for various reasons, we haven't seen perhaps quite as much activity as the sentiment might lead us to think. But I think the key thing to take away on this is that it's not really been about a lack of demand, it's been a lack of supply. And it won't be about a lack of demand in 2018 either if our survey respondents are anything to go by. So we do this survey every year. We ask about 150 global investors their views on investment into different parts of the world. And what's really interesting, we did this survey about a month ago, 90% of people expect demand for European property to either stay the same or increase in 2018. And that's up from about 70%, just under 70% this time last year. So demand, if anything, is increasing. Not surprisingly, a lot of focus is on Germany. What I think is quite interesting here is that France seems underrepresented at the moment, as it has done in activity this year as well. Spain is definitely back on the radar. I spoke to a colleague who runs our Spanish office the other day, and he said in his 20-year career, he's never had a time when actually every single part of the Spanish market is on the up. So they're incredibly positive, and I think that's been reflected in the sentiment that we see here. The other thing that I found was really interesting from this survey was about pricing. Now, virtually everybody expects pricing to either stay the same or improve in 2018. That's again up from last year by quite a significant extent, and I think it's doubly interesting when you actually compare that to where yields are across much of Europe. And I've just got some prime office data here really as a proxy, but incredibly low yields in many of these continental European markets at the moment. So if anybody's been in looking at this kind of data for a long time, we've never seen anything like this. And I think part of that is clearly just a huge focus on these markets and a relatively small pool of investable grade property in a lot of these places. Certainly not much of it necessarily trading. And I think we also have to think that in absolute terms these yields are clearly very low, but relative to bond yields, and there is an argument to say, well, that the spread is actually wider than normal. So maybe that's a sort of counterbalancing argument there. And so if our investor clients are right and demand is set to increase next year, then maybe there is, as sort of unlikely as it seems, a bit of scope for further yield compression in the year ahead. And the other side of the story, of course, is that in many of these places, very, very low yields do reflect, at least in part, some expectations for rental growth next year, and actually strong expectations of the type that we haven't really seen for many years in a lot of these markets. And we broadly agree with that view. We think when we look at Europe, in most of the key continental markets, we think that the rental growth cycle for offices is sort of either at the start or at best sort of midway through. So we do sort of buy that argument as well. And finally, just on Europe, it's very hard to talk about Europe at the moment without talking about the logistics market. I think we've all heard the story around logistics and the drivers for the change here, so we all understand this very well. But I think what I found interesting looking at this data is look at where London is versus some of these other places in terms of rents and yields. And you don't have to suggest that all of these markets are going to suddenly someday get to where London is, but I think that's a very good indicator of where the direction of travel is with both pricing and rental levels. And of course, London, the UK, is sort of really leading the way with the e-commerce driver, which is underpinning the demand and activity in this sector. So I think it's a very good indicator of where things could get to, particularly when you think about e-commerce sales at the moment. The UK, as I said, is the leader. We've around 17% of all retail sales in the UK at the moment are done online. In Germany, that's 15%. In France, that's 10%. And in Spain, that's 5%. So when we look at this, we see this is probably one of the few places where actually that it's really hard to argue with stronger rental growth next year and perhaps even some yield compression as well. Onto the UK. I mean, the UK is, as we all know, it's a very strange one. Everything seems different, but actually nothing in a way seems to have changed from this time last year. Particularly when we look at investment activity. And I think perhaps one of the things that we all sort of tended to underestimate this time last year when we were all talking about the outlook for 17 was the impact that weaker sterling would have on the market. I don't think anybody necessarily expected activity this year to be stronger than it was in 2017, and it's clearly been supported to quite a great extent by overseas investors who have come in partly off the back of that value proposition with weaker sterling. Now, a lot of the focus, of course, in the media particularly has been around the overseas buyers from places like Hong Kong, China and other parts of the Far East. And clearly that has made up a very important share of the London market in particular. Something like 90% of the investment activity in London offices has come from overseas. But it's not just been about overseas investors, because actually if you look at the country as a whole, if you look at investment activity, what we see is that the share of overseas versus domestic, it's about 50-50, and it has been, roughly speaking, for the last 3 or 4 years. So domestic investors have been competing just as hard as overseas investors for stock. It's just been a different type of stock. And one of the things that's really fascinating to get behind is just how focused some of these domestic investors have been on the kind of stock that they're willing to purchase. Not just in terms of the sectors that they're willing to go for, but in terms of the kind of quality of asset, covenant strength, length of lease. There's been a real laser focus in some cases. So we've had some very, very strong competition for particular types of assets, and then very, very weak demand for others that are deemed to fall outside of those key criteria. And so what that's meant is that we've had this massive disparity between the performance of the very best performing property types and the very worst, even at the MSCI level. So that's just at the sector level. Imagine what it looks like when you then drill down into the different qualities, different types of assets that underpin this data. Very, very significant disparity there. Overall, we see total returns coming in around about 10-11% this year. I don't think anybody expected them to be that high this time last year. I think the figure from IPF was somewhere around 1.5%. So a very, very significant change there. Some of this is just simply a sort of cyclical issue as yields compress at different speeds across the market, but a lot of it actually it's more than that, it's structural. There are some really clear structural changes in the UK market which we think are going to play out over the next few years, let alone just 18. We're all aware of what's going on in logistics, that's driving yields lower, we know that. Retail, is it the new industrial? It's certainly from an income perspective, it's providing stronger income than industrial at the moment, and that's something that we haven't really ever seen before. And clearly it's unloved at the moment in the investment market. Trading has been very, very thin. What we're seeing is that we need to see some pricing movement for this to change, but we're now starting to hear from people who are saying that when this happens, we are interested in getting into the sector in some way. So that's something that we're sort of keeping an eye on for 2018 as a sector that may be more active and perhaps is sort of being overlooked slightly at the moment. We could spend a lot of time talking about what's going on in the office sector. The London market in particular has been supported, but also being reshaped by the serviced office providers that are kind of giving us a different idea about what we want from our space and the kind of lease lengths that we're willing to accept on it. And then a whole other area of the market that I won't touch on really is the alternative sector. So basically anything that we call it alternative, anything that isn't offices, retail and industrial. I mean, this was a third of the investment market, give or take this year. So it's clearly a major part of the market. It's a lot more operationally driven. It's perhaps less susceptible to the whims of the economy generally. So we can see a lot more interest in this sector. We think that's going to continue for sure in 2018. Finally, just to finish on a couple of things, I mean, a couple of drivers for the market, things that maybe we sort of misread at the start of 2017 and I think will continue to be important drivers for the year ahead. Overseas investors, clearly not going to go away anytime soon, but I think really here what's important is that the mix is changing. And we're starting to hear from people who, were almost a given that they'd be keen to invest in the UK. They're now starting to say, well, look, the combined impact of changes to tax rates, changes to interest rates perhaps, changes regarding Brexit, things like that, it's starting to make them just think about whether they really want to be coming into the UK. And so if you listen to these kind of guys, it can paint a very, very gloomy story. On the other hand, every week we're hearing from new investors from places which we didn't necessarily think would be interested in the UK, looking to invest capital here. And it's really hard to generalise actually, because there are so many different reasons for people coming and spending their capital here. So it's going to be an important part of the market, but the mix, I think, will change over the course of the year. Platform trades, I mean, we've seen a number of these over the course of 2017. We think they'll become more important for a number of reasons. It's a good way of getting a lot of money into a market quickly. It's a good way of getting that money into a market if you don't necessarily have the expertise to run a portfolio. And also it's quite a nice exit strategy if you spend the time creating a vehicle. And domestic funds. A lot of funds have been sitting on large amounts of cash. That cash is rising, and there is pressure to invest. There's very, very significant pressure to invest. It's just about finding the right kind of asset. And I think that the issue that all of these kind of investors are going to find over the coming year is, yes, there might be a strong demand to deploy capital, but actually, if you're an investor holding the kind of stock these investors want, then you have to really weigh up, what are you going to do with that capital when you sell? Where are you going to invest it profitably? And so that might mean that actually some people that may have been sellers are just sort of holding back for a moment. Now, perhaps at the smaller end of the scale, the listed sector has been pretty active this year in raising funds, not necessarily raised as much as it would have liked to. Not all of this money has been spent yet. We're going to see that spent throughout the course of 2018, and we may see some more capital raising as well. Councils, again, not contributing huge amounts in the grand scheme of things, but these have been an important buyer of particular types of stock in the market for really where there isn't necessarily such strong demand, and they've got an important, clear rationale as to why they would do that. And then finally, debt. When we speak to our debt team, we sense there's a huge increase in appetite to lend, but the real question I think for 2018 is whether there's actually going to be the appetite to borrow. We've been in a sort of equity-driven market for so long now. Do we actually need extra debt capital to fuel the market? I think that the jury's still out on that one. So I think, just to summarise all of these things very, very quickly. In terms of the global market, I think we would say look at the private capital as just one area where we expect to see growth. For Europe, very, very good growth prospects at the moment, a strong year for investment activity ahead. And in the UK, it's going to be challenging, but I think don't underestimate the different pools of capital that are targeting the market. So I won't say anything more than that, and I'll hand back now to Richard. Thank you very much.
Thank you, Rick.